Hi, in today's talk, we're going to look at applying forensic accounting techniques using both the T-SQL and R programming languages. My name is Kevin Fiesel. I am the engineering manager of a predictive analytics team in Durham, North Carolina. I'm also a Microsoft Data Platform MVP, and I've got a blog, Curated SQL. The idea behind Curated SQL is that I want to try to find and link to 5 to 10 interesting blog posts per day. So interesting could be database development or administration. It could be security, Hadoop, R, Python. It could be Spark, Kafka, anything in this ever-broadening data platform space. So that's curatedsql.com. My talk today is motivated by something that happened in the Raleigh, North Carolina area about a decade ago. So in this scenario, the Wake County School District's transportation department ended up having a bit of corruption. The rough story of it was that there was an auto parts company that was working in conjunction with several county employees. These county employees would receive fraudulent invoices from the auto parts company. They would sign off on them and they would split the money. The way that they were able to get away with this is that at that time, only invoices over $2,500 needed 2 signatures. If your invoice was under $2,500, then you only needed 1 signature. So the auto parts company would submit an invoice under $2,500. One of the people involved in the scheme would sign off on it, and they'd get the money. This took years to figure out, and it went all the way up to the top. The director of the county transportation department was involved in it. The end result was that 3 county employees pled guilty, and there was jail time involved. As for the auto parts company, they had to pay a $2.5 million criminal fine, and the county clawed back as much money as they could find. All in all, county ended up getting back several $1,000,000, but they still say to this day, not sure if they got all of the money back. So as we go over our different cases, as we go over our different demos, and as I talk about these different techniques, I'm going to apply them back to this case study a few times because I think it was a really interesting study, not only in how they figured out what fraud was happening, but also why it took so long. So my motivation here is not to make you a forensic accountant. That is a profession that requires quite a bit of training. It requires a lot of experience, but we can take the techniques that they use and we can apply them in our own environments, even if you're not hunting down fraud, even if you're just administering a set of servers in an environment. The techniques and tactics that they use can help you become a better administrator or a better business analyst, because a lot of it just comes down to knowing your data. So we'll talk about that first. Then I'm going to cover some basic analysis techniques that they use, and we'll delve into a few more interesting techniques as well, looking at comparing cohorts, looking at market baskets, looking at data over time, and finally, looking at some numeric analysis. But first, let's cover the data. Knowing your data is vital. So you want to have as detailed an understanding of your data as possible, because that will tell you things like what are acceptable values, what are unacceptable values. It'll tell you whether or not you should expect something to be the case. It'll tell you what things should be linked together, how things are related in your data. There are quite a few bits of information that you can learn, and having that knowledge will help you perform analysis. In our case, we're going to look at a few public data sets. So these public data sets of interest, particularly Raleigh police incidents from the year 2005 into 2014. We're going to look at Wake County transactions from fiscal year 2016 to 17. We're going to look at historical Durham City budgets, fiscal years 2010 through 15. We'll look at North Carolina populations broken out by city, and I'll wrap it up with some information on my homeowner association's budgets. For your data, hopefully you have a rather detailed understanding of what it looks like, how it works. Now, I know that in a real environment, you're going to have possibly hundreds or thousands of tables. You're going to have potentially terabytes or petabytes of data, and it's not going to make sense to have a detailed understanding down to the finite grain level. But the more you know, the better your analysis will be. In this case, because I'm using relatively simple, generally public data sets, we only have a few attributes. We've only got a few columns for each data set, and so it's a lot easier to understand what's going on when there are so few working parts. Now, even within these data sets, I can tell you that the information is not complete. As one example, the Raleigh police incident data does not tell you anything about the officer at the scene, does not tell you about any people who are at the scene, either victims or perpetrators, because of privacy issues. We wouldn't want that to be in a public data set, so we're not going to be able to see it. If your analysis is trying to find something about a specific officer, this data set won't do it for you. Also, if you use data from Kaggle competitions, realize that they don't give you all of the information. Kaggle competitions are fantastic if you are a budding data scientist and you're interested in applying techniques to real data sets. Or if you're a well-established data science person and you want to make a bit of cash on the side. But what'll happen is that companies that put data in for Kaggle competitions will scrub the data. That means they'll take labeled data, they'll take category names, they'll take the strings and replace them with numbers. That way, their sensitive or confidential information doesn't leak out. You can still perform your analysis because the categorized data is still there, but you won't know the specific values of those categories. So it's something to keep in mind. Now, we're going to talk a little bit about some basic analytic techniques. I'm going to focus on a few important areas: growth analysis, looking at gaps in our data, looking at duplicates or what shouldn't be duplicates, maybe what should be duplicated, and finally, a quick regression analysis. For growth analysis, what we're looking at is how things change over time. Typically, we're going to look, say, month over month, year over year, week over week, and we're going to look at additive measures, that is, things that we can sum. So that might be number of employees, amount of revenue or cost, could be net margin, it could be number of customers, number of new customers. Whatever that measure may be, we're typically looking at it as a change in rate over time. And we'll want to see, is this change steady or is it weird? Do we have certain sets that are significantly faster in growth than others? So we're going to go to a demo and see a little bit more about this. In our first demo, we're going to look at some budgetary data for the city of Durham, North Carolina for fiscal years 2010 through 2015. I'm loading a few packages, including Lazy Eval, the Tidyverse, and Format Table. Note that I'm using Jupyter Notebooks for this. Jupyter is a freely available notebook system that will allow you to run different sets of scripts in many different languages. Jupyter is freely available, as I said. You can get it with Visual Studio 2017 Community Edition or any other edition of Visual Studio, or you can install it separately, like through the Anaconda distribution. I've installed a kernel that will allow me to run R scripts, and that's the code that we have here today. I'm going to start out by reading in our budget data for the city of Durham, and then the head function will allow me to see the first few rows of this data. So we see that there's some fund data, department data, the code that describes what this particular line item means, as well as some data for fiscal year 10, 11, and 12 actuals and 13 actuals. We can see some original and revised budgets in here. If I scroll to the right, we have original and revised budgets for 15 and a 15 year-to-date actual. So when I pulled the data, fiscal year 2015 had not quite finished yet. This is a data set, but it's not a tidy data set. See, I want to be able to unpivot all of these actual and revised budgets and turn them into something different. I want to turn them into a 2-column set where one column is the type of budget and the other one is the budgeted amount. So to do that, I'm going to start with our data, and I'm going to use dplyr, which is part of the tidyverse, to use the pipe function and pipe our raw data first to this filter function. This filter function looks for lines where in the fund it reads total. So there are some total rows in here where it's actually a subtotal. I don't want that because I can create my own subtotals. So this removes them. Then we're going to take the remaining data and pipe it to gather. Gather will unpivot our data. So we have fiscal year 10, fiscal year 11, and so on. I'm going to take all of those columns from fiscal year 10 actual through fiscal year 15 year to date. So it'll take all of these columns and it's going to turn all of that into 2 separate columns. One is going to be called FY, the other will be called amount. So we'll have the text FY13 revised bud in FY, and we'll have, say, this 218,664 as a value in amount. We're going to do that for every record in this data set. Finally, I'll separate out the fiscal year and the budget type. So I will break out FY10 actual after 6 characters, and I'm going to make it fy.10. And then actual or revised or original. So let me run through this. And we're not done with our processing yet, but I want to show you where we're at so far. So far we have a fiscal year, we have a budget type, and we have an amount. Now I want to turn this fiscal year into something that's a little bit more readable, like 2010. And then I'm going to do some character cleanup, turn things into more appropriate data types. Once I've done that, we can filter to get just actuals. So I'm not interested in the budget data for this notebook. First thing I want to do is look at dollar amounts. So I'm using ggplot to display a graph. If I run this, this is a bar graph that shows us for each fiscal year how much money the city of Durham actually spent. And what we see is that in 2010, the city of Durham had a pretty significant drop compared to the other 4 years. This was right after the recession, and so the city budget had not come back to a norm. After that, we see it hop up, and for the next 4 years, it's been fairly stable, close to $400 million a year. So that dollar amount is fairly consistent except for 2010. That's at a really high level. I'm also interested in seeing what does it look like for different departments within the set. So I'm going to take my actuals and I'm going to group by the fiscal year and department name, and then I'll summarize those results, adding a sum, and I'll call that total. And then finally, I'll sort the data by department name and fiscal year. Once we do that, we end up with a data set that looks like this, where we have audit services, budget and management services, and we see year-to-year data. Next up, I'm using a little trick to get percentage growth from year to year. So this percent change starts at 0% because we're in 2010. So everything will be 0. It's from baseline 2010. What we see is that audit services went up 5.3% in 2011, but then it dropped 1.6, and then it dropped 4.6. So we're seeing some changes over time in the different groups. So now I can reconstitute those values. What I'm doing is I'm going back to the budget summaries, and I'm adding in a total, which is a currency value. I'm then spreading fiscal year and total, and then adding a difference from 2014 to 2010. So let's show you this. This is now a pivoted table, which is what spread does for us. That pivots the data. So we've spread out 2010 through 2014. The difference is actually 2014 minus 2010. And what we see is audit services really did not grow. There's a $2,000 difference. But there are some cases that have grown significantly. Human resources had a huge jump. Non-departmental looks like it had a pretty decent sized jump. That's $8 million. We had some drops, like solid waste went down, and finance went way down. So finance is going to be interesting to look at. We'll come back to it in just a little bit. Human relations just fell off. It went from $580-some thousand down to zero. And in 2014, there was this $228. So let's take a closer look at that. I'm going to start with our budget, filter out human relations, spread, budget type and amount, and rearrange. These are all of the records for the different fiscal years for human relations. And what we see is actual budget, original budget, and revised budget. We have some actuals for 2010 and 2011 for personal services and operating expenses. In 2012, they were in the original budget, but they dropped out of the revised budget. So this money must have been moved somewhere else. In 2014, they just had $228. Perhaps this was a misclassification. If I were working for the city, I might look at that and try to figure out, well, where did that come from? I mean, it's a little weird, but it's only $228. So maybe somebody misclassified it. We have our budget data. So that was human relations. Let's see who has grown significantly. And I kind of eyeballed this a little bit, but I pointed out human resources had a big jump, $17 million. Water management, non-departmental went up, police, public works. Scrolling down to the bottom, I pointed out the big drop for finance, budget management services, general services, human relations. So we've got a few that dropped, most have increased, and a couple increased really big. So let's look at human resources, try to explain why it went up so high. And here we have our data starting in 2010. Here's this operating expenses. So there's some operating expenses in 2011, also some personal services, operating expenses, personal services. But where we're going to see something slightly new is that personal services went up a little bit, specifically around the general fund, and then more importantly, the employee insurance fund is in here. If we go back to previous years, employee insurance, that was $21 million. In 2010, employee insurance wasn't even on the list. So this was shifted over to human resources. And here in 2013, it was $28 million. In 2014, it's $28 million. That's a pretty significant shifting of money. And that explains our big jump, going from having that employee insurance somewhere else and going into human resources. The top 10 departments in the 2014 budget. So I'm filtering on fiscal year 2014, sorting it by the biggest budget, and we're going to see the top 10. So let's get the percentage change. And here we are. These are the biggest changes in percent for the 10 biggest departments. Finance, we can see, has consistently dropped over the past few years. That employee insurance fund is related to finance. General services had a big drop, but then it kind of increased. Fire has consistently grown at least 1%. Police has always grown somewhere between 1.5% and 4%, so it's another consistent growth. Solid waste grew in 2011, but then dropped since. And we can graph this to show some basic patterns. So this green jump, the gigantic jump, this is percent change. It's all about human resources. Otherwise, what we see is a fairly consistent increase in 2011 across the board for our top 10, except for the one that really dropped, which was general services. Then in 2012, we see that things shift around a bit. In 2013, we have some gainers and some losers. 2014 looks like we have kind of broad-based. Nobody's really taking off or really dropping that much. So things have kind of stabilized at the top 10. And so it kind of follows along with what we were seeing with the overall values. So that was our first demo. Coming back from our demo, let's next look at gaps in the data. See, sometimes it's not so much the data points themselves as it is what's missing from the data, which is most interesting. There are certain cases where we expect a sequence to happen, and we expect to see all of the elements of that sequence. One example is check numbers. If you're writing checks for a company, well, if you have check number 1024 and check number 1026, where's 1025? I expect to know where that is. That way, you can't take check 1025, write it to yourself, and destroy the evidence later. The company, when they're going back to audit, is expecting to see those numbers in that sequence. Other examples of sequences which are typically important may include invoices. It could include purchase orders. It could be receipts. Basically, most things that have to deal with money coming in or going out. There are a few constructs in T-SQL that will help us find gaps in the data such as this. The best scenario is gaps and islands. So we're going to take a look at that demo now. Let's now look at gaps in our data. For this demo, we're going to once again use a Jupyter notebook. This time I'm using Python as the language. And specifically, I'm using something that's called SQL Magic. SQL Magic comes from IPython SQL. So this is a Jupyter Notebook extension that will allow us to write SQL statements and execute them. So I've already loaded the SQL extension, and I'm going to connect to a PyODBC connection called Outlier Detection. This will connect to the Outlier Detection database in my SQL Server instance, and will allow me to, by using %%SQL, write T-SQL queries. So here's a query that creates an invoices table, and my invoices table has 6 rows. Notice that I have invoice numbers 1, 2, 3, and then 5, 8, 9. So I'm missing 4, 6, and 7. What I want to do is write a query which will find those gaps and show them to me so that I can easily see what's going on. There are a couple of methods that I can do to use this. Now, I've got a syntax here that works with any version of SQL Server from 2012 or later. If you're using an earlier version of SQL Server, you can still solve this, but you have to do a different method. The reason that I need 2012 is to be able to use the lead function. Lead will show you the next row. So it'll look ahead to the next row based on, in my criteria, invoice number. So we're going to find cases where the next invoice number minus the current invoice number is greater than 1. Any place where I have a gap. And we have the range start and end. So I see 4, and I also see 6 and 7. So these will show us the areas where there are gaps. It'll very quickly find missing numbers. Here's an example, slightly different, where I want to figure out the individual rows that are missing. So instead of seeing 4, 6, 7, I want to see 4, 6, 7 as 3 separate rows. I'm building a tally table in memory, and then I'm going to select all the numbers from tally, left out or join invoices. I need to have any number in my invoices table has to have a corresponding number in tally. So by doing 2, this basically gives me 2. Then I cross join, so that will multiply by 2. So I'm squaring it. So 2, 4, 8, and then I have 16, So I have 16 numbers that I've built up here. If I write it a slightly different way, I could say go select 1, union all, blah, blah, blah to 10. And then it'd go 10 times 10 times 10 times 10 if I needed a much larger data set. But I only go up to 9 in here, so I can get away with this. What I want to find is cases where invoice number is null and my n is between the invoice minimum and maximum. Running this query, I get back 4, 6, and 7. So this is a way that we can easily find missing values in our data, things that should be sequential, but we don't have everything filled out. As a word of warning, if you're using identity integers or sequences in your SQL Server tables, and you're trying to use that as your sequence, there could be inadvertent gaps. If your application is trying to insert a record into a table that has an identity and the transaction rolls back, that identity value is destroyed forever. Unfortunately, you may not have a good explanation of why that value is missing, and so when an auditor comes down, they're going to see the gap in there and they're not going to be very happy with it. If you are in a scenario where you need to collect this stuff, then the best case is probably going to be to create some central repository that will return back the next invoice number that will be entirely serialized. And this sounds slow already because it probably will be. And it also needs to protect against failures. So this is not an easy task. This isn't as simple as I'm just going to create an integer. Let's move on and talk a little bit about duplicate values. Now, there are a couple of different types of duplicates that I want to cover here. The first type is true duplicates, where you have two rows that have exactly the same sets of columns. They have the same values. Ideally, you don't have any of those in a table because how would you know which one is which? First normal form in relational database theory says that every single row is unique in some regard. There's some way to tell every row apart. And when you don't have that uniqueness, it makes it much more difficult to do data analysis later. There are other times, kind of going on the other track, where you expect two things to be the same, but they're not quite. They're mostly the same, but not exactly. An example for this could be a company name, the word foundation or the word fundation. It's just a simple typo, but really they were supposed to be the same thing, though in our database they're probably showing up as two separate records. There are a few measures that will help you find similarity in text. For example, you could use Levenshtein distance, or SoundX, or pattern matching. You could use fuzzy lookups in SQL Server integration services. You can use natural language processing techniques. You could stem the words. You could find ways of running through an automated spell checker. There are a few different methods that we can use to try to find this in text. But it does take quite a bit of effort. Going back to the Wake County case, this isn't a text-based duplication. This is more of a logical duplication. So they had, on 24 separate days, more than 50 invoices, all of them under $2,500. In this case, the duplication is in the number of invoices marked on the same day. That's pretty weird. Every company I've ever dealt with, they want to send as few invoices as possible. They certainly don't want to send you 50 on a single day. But here we are getting 50 invoices on 24 separate occasions from this auto parts company. That's already an indicator that there's something strange going on, and it's something that somebody could find with a fairly simple select statement. So let's talk a little bit about regression analysis very quickly. Regression analysis does have its own risks. It has its own important considerations you have to take. There are issues in doing regressions. You have to understand the data well enough to realize, is this something that you can perform, say, a linear regression on or a logistic regression? If you can perform linear regression, if you're expecting that pattern to hold, you still have to deal with potential issues like multicollinearity, serial correlation, heteroskedasticity. That's my favorite one. So keep that in mind, but in a lot of cases, just a simple ordinary least squares can help you get a picture of what your data looks like, what those measure values look like, especially over time. Here's a case that came from a study after the fact of the Wake County transportation incident. So what we have is school bus annual maintenance, and they have the individual data points based on the number of buses in service. So they're regressing the number of buses against the total maintenance cost in millions of dollars. And what they're saying is, if you plot it as a line, you can see this point is way above where it should be. In reality, I don't even think this is a linear curve. I think that this is a curve that's slowly capping off over time. I think that it's more of a, say, a logarithmic growth. Regardless of which choice you use, it's easy to see that this is a major outlier. And in fact, this was the primary year in which there was significant fraud, where we're millions of dollars over what the expected value ought to have been. So let's talk now about cohort analysis. Cohort analysis is all about trying to find not so much the relationships between elements, but how elements look in relation to one another. So what I mean here is, let's say that you have 20 sales areas. Those sales territories will generally sell a certain amount per year. If you're comparing sales territories, you may want to compare growth over time. You may want to compare total sales, maybe the number of sales representatives. You might look at the average age or average tenure of a sales representative in each territory. And those will give you insights on the sales territories that, looking at the overall aggregate, you might miss. One way that we can get this cohort level detailed data is in a nice visual format is called a box plot. Box plots are one of my favorite plots because they give you a lot of useful information all in one simple graph. So what we have here is a box plot of 6 different categories of police incident in Raleigh. We have the one that's blank here is actually assault, but what we see are 5 really important data points for each of these categories. We have the median, that is the 50th percentile. Sometimes in a box plot, you'll also see the mean marked as an X or a diamond. You have the 75th percentile, which is the top of the box. You have the 25th percentile, which is the bottom of the box. Then you take the interquartile range, so 50th to 75th, multiply that by 1.5, and go find the next data point that applies, and that's the top of the whisker. Anything above the whisker is an outlier, and those are marked as individual dots. Do the same thing on the other side, 1.5 times the interquartile range, go find the next spot, and that is your lower whisker. So now that you have covered the various quartiles and the interquartile range and any outliers, you can easily see that, for example, larceny has the highest median value in terms of incidence, and there are several outliers in the upward range, whereas burglary tends to happen a little less frequently than some of these other categories, and there's a fairly consistent number of incidents for burglary month to month. There are a couple of outliers, but that box is relatively flat. So when you're plotting, when you're looking for outliers, and outliers they may have a technical definition. You might say more than 2 standard errors away from the mean, or if you're this far away from the median, or if you just look at a plot and you see there's a couple of data points that are way, way beyond where I would expect them to be. That's a more it's a simpler form of saying outlier. It's not as technically rigorous, and that technical rigor is important, but sometimes you just want to look at a picture and you can easily spot the thing that is weird, the thing that is off. The existence of outliers by itself is not suspicious, however. There will be outliers in your data. You can expect that because regardless of the distribution that your data follows, you're going to have things at the edges of those distributions given enough data points. In fact, if you never see any outliers in your data, that itself might be suspicious. That might be somebody who's trying to fudge the data and keep it within reasonable bounds because outliers tend to draw our interest. So let's take a quick look at another demo, this time on cohorts. Here we're going to look at Raleigh police incidents from the year 2005 into 2014. I'm going to use R to analyze this data set. I've already loaded several packages. We saw the tidyverse and ggplot2 already. Our ODBC will allow us to connect to an ODBC instance, a SQL Server, and the other two are supporting packages that'll help us as well. First thing I want to do is connect to my SQL Server instance. I'm going to run this while I explain it. I'm going to connect my local instance to the Outlier Detection database. And then I'm going to query Raleigh 2014.incident. Those are the individual police incidents. I'm going to join it to an incident code and then an incident type table. And I'll show you what that looks like now. We have a few columns. Beat ID. This is which area officers were patrolling. It's a numeric value. We don't get the exact details of which beats they're on, but we can at least use this in our analysis. We have incident codes, which are the thing that an officer filled out. Each incident code ties to a description, and I've categorized those descriptions in higher level incident types. And we'll mostly be looking at incident type in our analysis today. We have the time, date and time when this occurred. We have an incident number, which is a unique identifier to tell us about that incident. So I'm going to do some data cleanup and also create a few columns, incident year, month, and day. I don't absolutely need to do this, but it does help a little bit in figuring out what's going on. I'm going to run complete cases. Complete cases is a function in R that will return true whenever every single variable in the record has a value. In other words, if there are any NA values, complete cases will return false. And what I'm doing with this structure is I'm going to throw away any rows that have NA, that have missing values. It turns out that I don't have any missing rows, so I didn't throw anything out. So it's a good thing. I'm going to create a couple more variables, a couple more data frames. Raleigh incidents by year, Raleigh incidents by incident type. So I'll take my Raleigh data, group it by year, and get the count of incidents per year. And I'm going to group it by incident type, get the count of incidents. First thing that I want to do is just get a quick plot. Let's see how many incidents there were per year. And we see roughly 40,000 for most years. It's fairly consistent. There's a huge drop off in 2014. This is not because the Raleigh Police Department did a fantastic job in 2014 or all the criminals left town. I pulled the data in the middle of the year, so this is not complete. That means if I'm going to do a year-over-year analysis, I probably want to skip 2014 because that's an incomplete year. Next up, let's look at a histogram of incident types. This histogram, what it's telling us is how many times a particular incident shows up in our data. So here there are 2 incidents that occur at least 80,000 times. There are 2 that occur somewhere between 10 and 20,000 times. There's a couple that occur, actually I think this is 4, this is 2, and these are 1. So these occur 30 to 50,000 times. What I find is I want to figure out, let's say, cut off at least 20,000 occurrences. That way, those are the most frequently occurring incidents, and I'll be able to look at those instead of having to see the literally dozens that are less frequent. The ones that are less frequent, some of them are fairly grisly, but they occur, thankfully, so infrequently that doing a really good analysis is difficult. So let's look at the things that happened at least 80,000 times. And those two things, larceny and miscellaneous. So I can find the stuff that happened at least 20,000 times. Assault, drugs, burglary, all other. So we actually have two separate categories that kind of represent grab bags of whatever. We'll deal with it. I want to do a box and whisker plot. I already explained how useful those are, so let's build one. We're going to build Raleigh incidents by type and month. So that's 2014 data. We're going to filter out 2014 because it's incomplete. And then we'll group it by type, year, and month, and we'll summarize. So I'm going to get a count of incidents by type, by year, and by month. And then I'll have the popular incidents. Those are the ones that happened at least 20,000 times. So once I have those, I can use the merge function and join together data. The tidyverse does have a join function, and if the join function makes more sense to you, go for it. Merge is kind of the older R function. Either one will do the trick here. So if you prefer join, use join. If you prefer merge, use merge. But what we're doing in either case is we're taking our incidents by type and month, connecting them to popular incidents, matching them by incident type. And this is the equivalent of an inner join. That way I filter out all of the other incident types. And then I can do a box plot, built-in function in R. The incident type will be my x-axis. The data will be my popular incidents by type and month. And I've put on a couple of labels. So what we see is data frame that looks like this, or an output that looks like this. Assault is the category that's kind of hidden here. It was a little bit too long to fit in. But what we have are the median, 75th and 25th percentiles, and 1.5 times the interquartile ranges. So next, I can look at incidents by beat. Here I've got my Raleigh data. I'm going to group it by incident type and beat and summarize. And I'll join the data to the popular incidents data frame, build another box plot. Here's my 6. So what I have is for miscellaneous. Notice that there are a couple of gigantic outliers. I mean, every one of these here has a few outliers, yeah, but these two are enormous. And I want to figure out what's going on here. So I'd like to investigate that later, perhaps. I can filter by another category, and we see once again, there's a couple of major outliers here. There are a few places where this particular incident has occurred 50 to 100 times, but up here, these are gigantic. And with more information, we'd be able to find out things like, well, are these the cases that it's happening most frequently? Are these the cases where the police officers around are most interested in finding the issue? Or maybe that the precinct captains are most interested in cracking down on it? It'd be interesting to look at that, to ask some questions. And this helps us focus the questions that we want to ask. Finally, doing some quick analysis of this data, I want to do a QQ plot. A quantile plot tells us how far off we are from an expected distribution. It helps us get an idea of how our data looks. I am going to look at a number of incidents by month. Again, filtering out 2014. So my expectation coming in is this data is going to follow roughly a normal distribution. That some months will have more, some months will have less, but overall it'll probably follow a normal curve. And I can build that comparison by building up my distribution and then comparing it to the norm using QQ norm and QQ line. It builds a graph like this. The line, this straight line, if we follow a normal distribution, we're going to follow this line pretty closely. And you can see that for the first half to 2/3, we're following that line pretty close. So up to this point, I would look at this and say, yeah, it looks like we have basically a normal distribution. But notice that it tails off very rapidly. Falls off much more than you would expect from a typical normal plot. Well, the reason that this is happening is that we have a fairly strong boundary. We have a 0 point where, for incidents, we can't have fewer than 0. And I'm grouping by year and month, but if we had a month where there were literally 0 incidents, that's our cap. We can't have negative. So what we're seeing is a different distribution. This actually follows closer to a log linear distribution, but that's a little outside the scope of this talk today. So at least we're able to see this does not really follow a normal distribution. Let's now look at Wake County expenditure data for fiscal year 2016 into 2017. This is another R package, so we're going to load tidyverse, which we've already seen a couple of times, and our ODBC. This will let us connect to our SQL Server instance database Outlier Detection. So let's run this. And here's my query. I'm going to join to the Wake transaction data and to the Wake expenditure line item data. So this will give me the actual amount and the expenditure line item name. I'm going to round the actual amount to the dollar, so that way we don't have to worry about any pennies. I've got a plot here that is the log base 10 of the actual amount. This way I can see a little more easily, because there are some amounts that are in the tens of millions of dollars, but we can see a couple of peaks. There's a big peak here, a big peak there. There's a peak here as well. Otherwise, we follow this general downward trending course. So I'm curious. This looks like it's pretty close to 0. It's pretty close to $1. This looks like it's somewhere between $10 and $100. This is 10 base T, 10 base log. So let's find out a little bit about these. I can take it and get the amount. So this is the actual dollar amount, 10 to the log actual amount. And that gets us out of log form. The 3 most common entries, $35, $2, and $165. So I look at that 35 and I say, that sounds interesting. It sounds a little bit like my lunch example. So let's dig into it a little bit more and see. Here's where I'm filtering actual amount equals $35, grouping it by expenditure line item, summarizing it and sorting. And what we see is inmate pay is the most common. 968 out of the 1,200 and some entries are for inmate pay. And then after that, there's phone charges, long distance, there's dental insurance, and so on. I wonder if inmate pay caps out at $35. And what I can do is filter where expenditure line item is inmate pay, group it by the actual amount, and we see, here's a plot form as well, that 35 happens to be by far the most common, but there's a range. There's some lucky sap who's making $130 over this time period, whereas the most of people are making $35. What about the $2 expenditures? I mean, 2 is an interesting number as well because it's so small. Disability and life insurance are the 2 most commonly used $2 expenditures. So disability pay, life insurance pay. I'm interested in seeing what's the distribution on disability pay. And we see the most common 2, 4, 6, 8, 10, 12, and then 1 and 3. If I plot disability pay, we see the big jump here. This is $2. We see the rest of them, and then as I get down here, we're at 2.5, log 2.5. That's somewhere between 100 and 1,000. It's like the $600 range. And here we are, $681. $624 is the next highest amount. So we have a few cases where there are several $100 paid out, but for the majority, it was $2. In addition to cohorts, we may also look for where data clusters. By clustering, I mean you see a lot of data points all in roughly the same area. As an example of this, let's go back to the good old days of submitting lunch invoices, where if you were out for an event and you were going to lunch and you had a meal that was under $20, sometimes you didn't even have to submit a receipt. You just mark down the amount, and as long as you're under that cap, they automatically paid. Well, in those cases, you would see a lot of lunches that were all in the $19 to $20 range. You'd see very few that were way under $20. In reality, some people would go to the grocery store, buy $3 worth of food, and make that their lunch and pocket the other $17. Well, this has changed. Now typically you have to have a receipt for every purchase because of reasons like that. Another case, going back to the Wake County transportation fraud, is that if we looked at behavior, especially by company, we would see that this auto parts company clustered near $2,500. There were so many invoices that were very close to that range, more than what you would normally expect for an average customer. This may have been an indicator of suspicious behavior. It might have been harder to find in this scenario. Other things like regression analysis would have made that easier, but it's still a factor. Another thing that I want to talk about here is differences. So you're comparing two cohorts, or you're comparing members within a cohort. There are a couple types of differences. Those differences between cohorts, differences between groups, and differences within a group. Within a group, you may wonder, how much range is there? You say, going back to sales territories, how much of a range is there from the best salesperson in the territory to the worst? And is that fairly consistent across territories? Or are there some cases where some people are just way better than everyone else? So you're looking at that across territories, but also within a territory. If you're consistently seeing that one territory is just killing it while everyone else is not, perhaps there's something within that territory. Maybe it's the manager doing a better job, maybe it's better incentives, maybe it's just your product sells better in that area. But this at least opens the door to further analysis, further understanding. So let's now look at another demo. Previously, we noticed that there were two beats with a high number of miscellaneous instances, and so I've decided I'm going to try to dig into it. I'm going to make sure that PyODBC is installed. We know that it's actually installed because I was using this earlier, but just to show you, I'm loading the SQL extension. That way we have SQL magic. I'm going to connect to Outlier Detection, and I'm going to pull data where the incident type is miscellaneous. We saw before in the cursory analysis that miscellaneous had a couple of significant outliers. So let's run this, and what we see are the two beats that are way higher than anyone else, 2403, 2402. Now I don't know anything about these beats, although I could see, the IDs are right next to each other. Perhaps they're geographically coordinated, they're geographically located, but I can't tell you that for sure. What I can do is run this query and see what exactly the incident description was where our incident type was miscellaneous. The most common was mental commitment, followed by no offense committed. So mental commitment is obviously the difference maker, making this the gigantic outlier. What about beat 2402? Well, we see the same thing. Mental commitment, again, significantly more than anything else, makes it an outlier. So now I want to know, well, what are the latitudes and longitudes of the incidents in those two beats where we're dealing with mental commitment? And here's the breakdown. 3578, 3579, and longitude of negative 78, 59, 58. We have 2,700 incidents, 1,900 incidents, 1,000 incidents. So basically all of them are happening near about the same area. And I plotted this on Google Maps, and I noted that here's a point, here's a point, here's a point. This is sort of our box for where all these incidents occur. And here there's an addiction treatment center, and here there's Wake County Human Services. So what we can see is, based off of this analysis, our outliers are happening because there's a special facility here, and police are generally involved in taking people to this facility. So now let's talk about market basket analysis. Market basket analysis is also known as association studies. The idea is that you want to try to find what things occur together. The classic scenario for market basket analysis comes back to the 1970s when a supermarket chain commissioned a study to find out what items were purchased together most frequently. And the single most common occurring item purchase was diapers and beer. Now, the owners of the supermarket said, well, we're not going to put beer next to diapers. But what they could do is put them on opposite sides of the store. That way, people who are buying both have to trudge from one end to the other, during which time, hopefully, they're going to go down a couple other aisles and find something interesting. A company that typically will use market basket analysis is credit card companies. For example, if I, say, get an airline ticket to Las Vegas and I get a rental car and a hotel, and then I go and spend a bunch of money at restaurants and casinos, the credit card company is going to know that's me spending the money because I got the airline ticket, I got the hotel, I got the rental car. Those are consistent behaviors with somebody who is traveling. In fact, my credit card company will send me emails saying, hey, we know that you have a travel coming up soon, so don't worry, we've already cleared you for expenses in that area. And that's pretty cool. It's a little creepy, but it's pretty cool. At the same time, if I'm spending this money in Las Vegas, if I'm making these charges there, and somebody is purchasing gasoline in Albuquerque, that seems a little weird. Maybe it's not incredibly weird, it's just a few hours away, but if I'm making purchases at the same exact time, the credit card company has a pretty good idea that, especially if it's, say, purchasing gasoline in Albuquerque, that's usually behavior fraud, where somebody might have stolen my credit card number while I was out having a good old time, and they're testing it out at a gas pump in another state, and then they're going to try to milk that card for all it's worth. So credit card company will automatically shut that off. They'll decline the card. And if it is actually me, I drove to Albuquerque and I need to buy gasoline for some reason, I can call in the service, or they'll send me a text message or something, and I can override that rule. But they have those rules in place about associative behavior, and it helps them detect fraud very quickly. Going back to our scenario with the Wake County transportation fraud, we could have looked at an analysis of, say, government employee and vendor. I don't know if there would have been anything there. In many cases, just because there is a link doesn't necessarily mean anything. So there may be, say, 24 main vendors and 5 or 6 employees. Well, if you have that many vendors, that many employees, oftentimes you'll have the same employee work with the same company and just deal with that company. They form a relationship, and that's not weird at all. But if your company predicates itself on the idea that all of the employees should hit all of the vendors equally and there's a major skew, that might be something to investigate. So here, market basket, this association analysis might have been interesting, but it would have been a little bit of a stretch. It would have been a nice addition as opposed to a key indicator of finding the fraud. So now let's talk about time series analysis. Time series analysis is pretty simple. It's looking at changes in measures over time. For example, counting the number of items sold per day, or counting the total revenue per day versus the total cost per day. In our Wake County example, if we look at the total number of invoices per day broken out by company, we would have seen that issue where we had 50 plus invoices on the same day, which is really weird. And that would have happened 24 separate times. Again, that's pretty weird. Another time series example, I already talked about sum of revenue versus cost, or number of orders, total amount of refunds. Basically, we're looking at adding up values over and looking at that over time. Sometimes you can't add up the values. Bank account balances are great examples of non-additive, well, they're semi-additive measures. The idea is that I can add my bank account and your bank account and somebody else's bank account, sum all of those up, and you have the amount of funds that the bank has that they're willing to give out. But you can't take my funds from yesterday and my funds from the day before and my funds from today and add those up. If I had $20 on the first of the month and I still had 20 on the second and 20 on the third and I spend 10 on the fourth, I can't go to the bank and say, well, 20 plus 20 plus 20 plus 10, I have $70 in there. The bank's going to say, no, you don't. You have $10 in there. If you have a semi-additive measure like bank account balance, the best case is taking a snapshot of the data at a consistent point in time, like, say, 9 p.m. UTC. Let's say that's your clearing time. All transactions are cleared at that point. At that time, I would take snapshots, and you can compare the snapshots, and you can see how my data has changed over time. You can see how total account balances, how total holdings have changed over time. When you're doing these sorts of time series checks, look for odd combinations. Maybe is your order date later than your ship date? Is that possible? Maybe that's weird. It could be possible that you really do have a ship date that's earlier than your order date, but if your company doesn't allow that, that may be an indicator of something. If you have adjustments after the journal closes, that's usually pretty weird. So behavior based on date is interesting, but the attributes of the date can also be interesting. How do things look at the beginning of the week? Look at Mondays over time, or Fridays over time, or Monday versus Wednesday. Potentially look at holidays or weekends. If we see government behavior, well, most government employees will take Saturday and Sunday off, especially ones that deal with accounting. And so we'll have fewer transactions, we'll have fewer operations that are marked on Saturdays and Sundays. Federal holidays, same thing. Employees are going to be off. They're not going to be filling in those records on those days. So it's important to keep that in consideration as you go through this analysis. And here's my point on holidays again. Sometimes those holidays are consistent in our calendar. Christmas is always on December 25th. New Year's Day is always January 1st. Sometimes they're not consistent on the calendar. Easter follows a lunar calendar, and so it is a consistent day on a lunar calendar, but it can fall in different times in March or April on the standard calendar that we use. That makes it kind of important to keep track of those holidays. It's a lot easier doing that than trying to calculate them on the fly. So let's look at another demo. Let's now look at some time series data using Wake County transactions. I'll once again ensure that I have PyODBC loaded, that I have IPython SQL loaded, and my SQL extension. We'll connect to the Outlier Detection database and look at the record date and the number of transactions in our Wake County transaction table where the actual amount is greater than $0. There are some negative values. I'm going to ignore those for the moment. And what I have is a day-by-day breakout of the numbers. Notice that there's nothing between after July 3rd and before July 7th. Well, that's July 4th and then a weekend. So we have day by day, and you can see that there are some big numbers and some small numbers, but it's kind of hard to tell exactly what's going on as you're just scrolling up and down this data set. So instead, let's look for cases where the number of transactions is greater than 1,000 for a particular day. Here we go. We have a Friday, Friday, Friday. We have a Sunday, a Wednesday, Friday. Friday happens a lot on here, but it's, there's some other factors that are obviously dominant. This is the end of the month, probably paychecks. The second of the month is interesting. Second. So notice the second of the month is a big thing here. And end of the month, middle of the month. So these are kind of in the middle of the month. So we're seeing a couple of patterns. The second of the month, the end of the month, Fridays, and right in the middle of the month. Those seem to be when the greatest number of things happen. Well, end of month and middle of month, those are probably related to paychecks. What's interesting is, what about the second day of the month? So I picked one of those second days of the month, September of 2016, and I want to see what's actually in there. And here are the expenditures. As I scroll to the right, we see the actual amount. We see what the line item is. We see vendor name, P card. As I scroll down, more P card, P card, P card. We're seeing a lot of P card. Those are payment cards, paying off credit cards. So, is this why the second of the month is so much bigger than everything else? Is this just when the county pays off credit cards? Well, I went back to September 2nd, and 1,572 of the transactions are payment card. More than, obviously more than half, nearly twice as many as the number of non-payment card transactions. So yeah, this is when they pay off payment cards, at least for that month. Let's check that out for other days of the month as well. The second here in July, payment card, big percentage, and then there's some on the third. As we go down, there are no others. On the second, a couple of them are paid off in the middle of the month, but we're seeing a pattern here where it's at the second day of the month that almost all of the payment card transactions happen. So the reason that the second of the month is so popular is because we have so many payment card transactions. Let's next look at negative amounts. So far, I focused on the positives. When we switch to negatives, we have a lot of them on the 15th. We have a lot on the 29th, the end of the month, middle of the month, end of the month. So we're already seeing a pattern here where the big numbers are at the middle of the month and the end of the month. My conjecture is this is probably related to employee plans. But we can find out for sure. So we're looking at actual amount less than 0, focusing in on a specific date that was on the list. And what I have is, as I scroll down, dental plans. Keep scrolling down. So far, this has been all dental plans. I'll just mouse down quite a bit. And then we switch to health plans. So dental plans and health plans. These are the employee shares of those plans. I can get a rough idea of what the benefit levels for county employees are by running this query that sums up those negatives. And what we see is employer is paying out $52K, employee is about $44K. Here, employer is roughly 5 times as much as employee. And you scroll down, and it's fairly consistent. So basically, the dental plan is about a 53-47 split. Health plan's pretty good, though. It's an 80-20 split. The last major section that I want to cover is my favorite. This is numeral analysis. Here, we're going to look at the specific numeric values in our data and potentially find interesting patterns. The first area that I want to cover is round numbers. So one high-level analysis of our data and potentially whether somebody's monkeying with it is to look at the count of round numbers. And we group this based off of the number of zeros at the end. So for example, the number 5,000, we're going to lop off any cents, so it'll just be dollar amounts. 5,000 is a type 3 round number because there are 3 zeros at the end. $10,001 is a type 0. There are no numbers that are 0. There are no trailing zeros. Those middle zeros, they don't count. They're just numbers. We're only looking at trailing zeros in this case. So let's go to a demo. Now we're going to perform some round number analysis on our Wake County transactions data set. Once more, I'm going to ensure that I have PyODBC, that I have IPython SQL installed, and that I've loaded the SQL extension. Here's Wake County transactions. I'm rounding it to the dollar. I don't really care about cents on this. And I'm building up types. So a type 4, type 3, type 2, type 1, and type 0. I use cross apply to figure this out. Type 4 is where I can divide it by 10,000 evenly. That means there are at least 4 zeros at the end of my number. So if that is a type 4, then I mark it in here as type 4. Otherwise, we go to the next cross apply and we say when type 4 is equal to 0 and it's divisible cleanly into 1,000, or excuse me, cleanly by 1,000, then we'll be at is type 3. Okay, if that's not the case, is type 3 is equal to 0 and it's divisible by 100, then it's a type 2. If that's not the case, if type 2 is equal to 0 and we're divisible by 10, then we're type 1. Otherwise, if we're not a type 4 or 3 or a 2 or a 1, we're a type 0. So I can run that query, and it gives me back our breakout. So this is by vendor, and it shows the percent type 0, the number of invoices, and the different breakouts. As a very high-level assumption, we would assume that all other things equal, if we have no other information to go off of, that the percent of type 0 should be about 90. That is, we have a uniform distribution, 0 through 9, each number is evenly showing up in the data. Well, 9 out of 10 times it will not be a 0. So we'd expect roughly 10% to be non-type 0. And that uniformity, to an extent, we can kind of expect it to go up the ladder here. So roughly 90% of them will be type 1. Roughly 90% of the remainder will be type 2. Roughly 90% of the remainder will be type 3. And so on up the chain until we run out. Well, this is going to be kind of hard to look at a category by category basis because, like here, okay, only 4 of the 10 are of type 0, but there's only 10 rows, so it's kind of hard to see the pattern. So instead, let's look at it at a slightly higher level. Let's look at it overall. Overall, 84.8% are type 0. That's a little lower than we expected. But of here, type 1, roughly 80% of them are type 1. You go here, roughly 80-some% are type 2. But then I would expect these two numbers, I would expect this to be much closer to 450 and this one to be somewhere around 150. So we have a disproportionately large number of type 4s. So we can investigate. Let's find out, what do these type 4s include? Well, as I scroll down, we have some payouts, we have internal charges, we have prior year expenses, there's a lot of these. We have prepayments to the United States Postal Service. So prior year expense is a big part of it. That's about almost half of the entries. Other than that, we're probably looking at county payments, where there's some service that's being paid out in advance. It was already negotiated, and it might be a grant. Grants tend to be written with big round numbers. They don't tend to have $37,904.11. Instead, they'll say, okay, $38,000 or $40,000. Just makes it easier for everybody to do the paperwork. So, looking at this, it doesn't look necessarily that weird, but we are able to dig into it and find that it was different from a basic expectation, although we can go back and talk to the business people and find out that it's a perfectly legitimate use of the money. Now I want to talk about Benford's law. Benford's law is a fascinating phenomenon. The idea here is that we have a set of data, and the leading digit in our data set will often follow a pattern where the number 1 will be the leading digit nearly 30% of the time, and then number 2 will be the next most common leading digit, on and on until 9, which happens at a frequency under 5% of the time. This is common. This happens in a lot of cases, and we're going to look at a couple of them now. So let's go to our latest demo. In this R notebook, we're going to look at Benford's law. First, I need to load a few packages: tidyverse, Benford Analysis, and Mass. Benford Analysis will let us very quickly draw some conclusions about whether something follows a Benford distribution. But first, let's manually build a data set. Here I'm taking the digit and the frequency of occurrence. What we find out is that if you follow Benford's distribution, then 1 will appear 30% of the time. 2 will appear 17.6% of the time. 3 will appear 12.5% of the time, and so on until you get to poor number 9, which is only 4.6%. So we'll run that. I'm also going to create a function that strips out the first digit of some value. We're only interested in looking at the first digit here, not all digits. My data set is population for cities in North Carolina as of 2013. And what I see here are the 5 biggest cities. Charlotte has 818,000, Raleigh 440, Greensboro at 280, Durham at 250, Winston-Salem at 238. So what I'm interested in are digits 2, 2, 2, 4, and 8. And then also, obviously, the digits for every other member of the cities in North Carolina. So I'll pass this population data frame into the first digit function, and that will give me my North Carolina population first digits. I'm going to build a histogram to show the distribution of those digits, and we'll overlay it with the Benford prediction points and lines. So it looks like this. This looks pretty close to fitting a Benford distribution. The number 1 doesn't show up quite as frequently. 2 is a little less, but the rest of these tend to follow fairly close. So just eyeballing this, I can say, yeah, this is a Benford distribution. Populations and areas tend to follow Benford distributions really, really well. So let's next use the Benford analysis. And to do that, I just call the Benford function off of my population data frame. Number of digits will be 1, and I can plot the results. So here's what I have. This is a fancier version of the chart that I just drew. We also have a few other pieces of information. The Benford analysis tutorial tells us that if you look at the mantissa, we're going to see some interesting values. These are the ideals. If you're hitting these, you have a perfect Benford distribution. Well, our mean is dead on. Our variance is ever so slightly smaller. Kurtosis ever so slightly smaller. Skewness slightly smaller. So we're very close to the expected results. We're not precisely at those expected results, though. I can also look at two-digit sampling, and we can see some spikes. What's interesting with the spikes when you're doing two-digit sampling is that happens usually when you have round numbers, when you don't have a continuous variable, which is true for this, where we're rounding things off. Also, I want to look at my homeowners association's budget. So I have data for my HOA for the years 2013 through 2015. I'm loading that data up, and here is how it looks in a Benford distribution. So notice that I'm a bit high on the 1s, and I'm way low on the 8s and 9s. 5's a little low as well. So let's look at 2014. Again, high on the 1s, low on the 9s, 5's still a little low. 2015, 5's on the spot, still a little high on 1, 8's gone, 9's low. Let's do the overall. This is what it looks like overall. 5's a little low, 8 and 9 are low, 1 is high. If I show my mantissa, the mean is a bit low, the variance is a little high, kurtosis is low, skewness is high. So I'm a bit off. It's not nearly as good of a fit as our first example. But that said, before I go accusing my HOA of fraud, realize that there are only a couple hundred rows in there. So it's not a large enough data set to confirm, yes, you definitely have a problem here. We can expect some deviation from expectations. So how about last digits? We saw Benford's law held for North Carolina's population and a little bit for the HOA. It was off, but it wasn't radically off. Well, if I grab the last digit and I try to apply, we can see that the last digit actually is pretty close to uniform. This is for the population of North Carolina. So it's pretty close to uniform. 0, 1, 2, 3, 4, 5, 6, 7, 8, 9. Well, obviously doesn't follow Benford's law. Benford's law only applies to the first digit. If we look at my HOA, I have a completely different story. Almost all of them start with 0 or end with 0. It's because it's a budget. With budgets, we rarely pick numbers that are other than 0. Here it may be like this is a 5. Say $905 because we got an estimate that it's going to take $905 to repair that faucet. In that case, they would budget exactly $905. But usually, over 90% of the time, it ends in a 0. At this point, we've looked at trailing numbers, we've looked at leading numbers, but our trailing numbers have just been round numbers, zeros. Now I'm going to look at an analysis of last digits. The trick with last digits is we can normally assume that they will be uniform unless we have some reason to believe otherwise. A reason to believe otherwise could be budgets. Budgets generally will end in a bunch of zeros, but numbers that we just pull out, like population totals, we can assume that there's no special distribution of the last digit. If there is a special distribution, then that could be an indicator of fraud. This is a graph that was taken from a blog post by Professor Andrew Gelman. Gelman's blog post is covering a scenario where it looks like there was fraudulent data collection. One of the ways that this graph looks suspicious is that the last digit, which ought to be uniform, follows a couple of patterns of data fudging. One of those patterns is that the numbers 0 and 5 tend to be under allocated, because when somebody's fudging data, they want to pick random numbers, and 0 and 5 are not random enough for that. So people will tend to underselect those. They'll tend to select more random numbers, 7 and 8, 2 and 3. So here we see that 3 happened a little bit more frequently, but really it was 7 and 8 that really kind of pushed the edge. Just because you see this pattern does not by itself mean fraud, but this combined with a bunch of other things make it look like that the data itself is completely bogus. So wrapping up, we've covered a few techniques that forensic accountants use. We've looked at this outlier detection analysis. We've looked at techniques, for example, cohort analysis, time series analysis. We've looked at specific numeric values, first digit, last digit, trailing zeros. These are things that accountants will use in order to try to determine whether or not there is fraud in a data set. But we can take them and use them in our own data sets, not to find fraud, but to find what our data looks like. What is the shape of our data? What is the content of our data? And does it behave the way that we expect it to? If you'd like to learn more, if you go to csmore.info/on/outliers, I'm going to give you the slides. I'll give you links to additional resources, and I'll also point you to my GitHub repo, which has the notebooks that we saw today, as well as the data sets that we used. If you have any questions at all, please feel free to reach out to me. Hit me up via email or by Twitter. Thanks for watching.